I'll try to be as brief as possible, but if there are questions, please interrupt me as I go along. I work for CDC, which is the UK Development Finance Institution, through my own company. I advise CDC on environmental, social and governance standards for CDC's investments, as well as on monitoring and evaluation. And last year I worked with CDC very extensively with Department for International Development that owns CDC on upgrading and developing a new investment code for CDC for how to think about environmental, social and governance matters throughout the investment process, and then building that investment code into the new monitoring and evaluation framework for CDC, which I'm going to spend most of my time, a short time, talking about. CDC is, if you want, in the where business meets donors, entirely owned by the Department for International Development, but investing through commercial fund managers, private equity funds. We have 2.7 billion committed to 127 different funds, with current investments in 682 different portfolio companies across the emerging markets. So in the poorest countries, our focus is Sub-Saharan Africa, but also other low-income countries, India, Southeast Asia, less going forward in Latin America and China and other middle-income countries. We work, a core focus for CDC is to bring along more capital to these markets, which are traditionally underserved by private investors. So a core focus for us is to invest through fund managers with other commercial investors investing alongside CDC. CDC's fund managers then invest in companies in these emerging markets, and invest for the long term. Typical holding period would be 3 to 5 years, so plenty of time to work with the companies and improve upon their businesses, certainly from the financial perspective, but also from the environmental, social perspective, governance perspective, and broader development effects until the time when fund managers see what happens, right? Sell their portfolio companies and return the proceeds to CDC and other investors, which then leads to CDC reinvesting that capital in other promising businesses in these universes. What is our objective? Well, we need to demonstrate that CDC's investments is indeed good for development, so that would be the prove it in Karen's words. But most importantly, I think, is to improve it, to use the information that we collect as a management tool for CDC, for the fund managers we invest with, and for their businesses to improve their investments and business practices from various perspectives. Thinking about it in, I guess, as a chain of different stages through something that is often referred to as the log framework. The input here would be CDC's capital with fund managers in poorer countries, along with a third-party capital invested alongside CDC. And that's where CDC's capital can be a lever on additional money being made available for businesses in these emerging markets. The fund managers then in turn invest CDC's capital in commercially viable, otherwise it would be wasting that public capital, but crucially responsible managed companies that pay attention to environmental and social matters and governance in the broader sense, including business integrity criteria, and that work with these companies to bring about improvements over time. The outcomes then that we're interested in, really, we're on the development side, would be certainly profitable and growing businesses that would contribute to economic growth. The jobs and tax revenues that they would generate through increasing the size of their operations, making available more products and services to people in these markets, and increasing the commercial finance available in countries that are traditionally very short on capital for businesses. Eventually, certainly what we're interested in is how these businesses contribute to poverty alleviation, helping people help themselves through employment, through better opportunities, helping themselves. Economic growth brought about partly certainly by businesses, but also a range of other factors in improved capital markets. We want to be very careful with attribution. There's certainly a variety of factors at play for what we're eventually striving to be a part of, that you can only capture when you would do more thorough evaluations. But we try to ex ante, both through our investments with fund managers and with the practices of these fund managers, do environmental impact assessments, social impact assessments on par with the financial assessments that would be made of these investment vehicles, especially for companies investing in high-risk sectors like mining or oil and gas. In monitoring, we try to capture that information depending on what it is on an annual basis or for financial parameters more frequently, and looking really both at the quantitative and the qualitative aspects as we do so.
2 minutes, right?
Yeah. Okay, what are we then looking at? Well, we try to integrate the economic and the financial performance. I think we've heard quite a bit about, so I won't spend any further on it. We're doing the same as we've heard from other actors, looking at employment, taxes paid, on the economic parameters, but really from the private sector development perspective, looking at how different sectors have positive effects for the people in these emerging country environments in terms of bringing new and better goods and services, better quality pharmaceutical products, certainly increased mobile phone penetrations, better and new infrastructure, serving rural customers with power that was previously not available to them, and bringing micro credits to the poor. So on the private sector development dimension, we try to capture the breadth of positive effects that various types of businesses in poor countries can have for the people and in these markets. What we're really looking at is improvements over time. Certainly businesses where our fund managers invest may be, high polluters or may not have sufficient health and safety practices. It's then our fund managers, assisted by CDC, that would work with these companies to bring about improvement over time and report to us as such improvements are realized. And we have a toolkit that I left some copies of outside on how businesses across the spectrum can think about improvements over time on how they manage environmental concerns, social matters, and business integrity aspects. Let's see the last slide. We also think about how we, CDC, can help fund managers do our job better, the 59 fund managers that we invest with. If we can help them raise further capital, that's something that we try to do, primarily from commercial sources. Also try to help them if they're, for the first time, trying to run a fund in West Africa, in Nigeria, in helping them think about their ESG, environmental, social and governance management systems, and how they can work with companies to bring about improvement over time. Of course, it's very difficult to make any direct attributions, but we want to think of CDC's input and on an as-needed basis, working with our fund managers and the businesses they serve as they need us to, depending on where they are in their own practices. Yes, I've left this presentation outside so you can see a little bit just how we think about the key challenges. I think the most important there is to be very practical and simple, trying to do this, and to really showcase best practices from an inspirational perspective, showing that financial returns and development effects can be complementary, and how businesses across different sectors can showcase for one another how that can be done, and certainly very inspirational for businesses we invest with to learn from, you know, the huge global actors like Vodafone, Unilever, and Anglo American that we've heard from, on how they can work with their own practices for development.
Sorry.